Hi, everybody.
Hi, everyone. Thank you for joining us. It's a wild and blustery day out there on the Gold Coast today.
So my name's Leishan Smaller and I'm a director at Element, and I'll be your moderator again today and a panelist. So our webinar today is a sequel to the 7 Ways to Grow Your Business, which we held last month. And that webinar detailed strategies on how to improve and grow your business. Today, we're going to dig deep into the numbers and help you explore what your numbers are telling you so that you can act quickly and adapt or adopt the strategies that we spoke about previously to benefit your business. And I have to work out how to change slides. There you go. I think I was actually supposed to be on that one, but let's keep going. So Zoom settings. So for those who are unfamiliar with the Zoom settings, you select your audio settings here just to test your speakers. Submit any Q&A questions that you have over here. We'll probably, because I'm not very good at multitasking, we'll probably look at these towards the end of the webinar. And of course, you can leave the meeting at any time and you can rejoin using your same link. So I'd like to introduce you to my fellow panelist, Teresa. So she's my business partner and a director at Element, and she is going to kickstart today's webinar. Go for it.
Thank you. Thanks so much for joining us. Like I said before, and taking the time to listen to this webinar. We're going to go through some numbers, like Leishan said. It's going to be a little bit dry, but we'll try and make it as exciting as possible for you. That's what we're here for. That is our challenge. So what I thought I'd start off with is I'd like to share a thought from Jack Lew. He was the former US Secretary of Treasury under the Obama administration. And he said, he said, the budget is not just a collection of numbers, but an expression of our values and aspirations. How true is this? So when we set a budget for our business at the beginning of the financial year, it's a great time to consider and reflect on where we'd like our business to be in 12 months' time. Now is a really good time to start setting your budget. So we've got 3 months left of this financial year. It's a great, it's gone by so fast. It is. So it's a really good time to start thinking about the next 12 months in your business and where you'd like to be headed. And putting a budget together to do that is one of the best ways to do it. You should also factor in, any aspects and changes in the economy and the world around us, including the COVID-19 situation. Once your budget is set, then it's a really good time to make sure you can understand it, monitor it, and measure what you set in that budget. And that's what this session today is all about. So before we move on to the next slide, a question for you all is, do you have an active budget in your business right now? And if you do, how often do you monitor it?
Okay, so this webinar is going to run between 45 and 60 minutes, and we'll cover the importance of why you need to know your numbers. We'll look at some of the different reports that you should be producing, the difference between profit and cash, which is an all-time favourite, the key drivers of business value. We'll also look at how to protect your assets, adopting best practice and some strategies around that, and then we'll look at some next steps and question time. So like we said, I would make plenty of notes today. Some of what we're going to talk about might sound a little bit technical and very dry. I'm so sorry about that. But we are going to dig deep into your numbers so that we can help you read the story that they're trying to tell you.
Thanks, Leishan. So to kick off with the agenda, why do you need to know your numbers? So as Leishan mentioned, they tell the story of your business. So by knowing your numbers, you can interpret the results of your business activity. The second reason why you need to know your numbers is you get to identify symptoms versus root causes. So for an example, if you have a decline in gross profit in your business, that is a symptom of many root causes. So, for example, a decline in profit might mean that there's ineffective pricing, or there's rework required, or there's wastage. Another good example is cash flow. A cash flow is a symptom. So if you can identify poor cash flow issues, then your numbers will help you identify the root causes so that you can start fixing them. Another reason why you might want to know your numbers is they give you early warning signals. So if there's a potential issue and you can look at your numbers, then you can identify what those signals are and do something about it straight away. Another reason is if you know your numbers, you can identify areas of strengths and weaknesses within your business. So, for example, your balance sheet is a really good indication as to if your business value is going up or down, for example, on a very basic level. Another reason is that if you know your numbers, it supports better decision making. So, for example, every time Leisha and I decide on spending money in the business, we consider what the impact of that is, and we decide, will spending this dollar actually help us grow our business? So by having the numbers in front of you, it allows you to make that decision making in a better and more powerful and more impactful way. And finally, knowledge is power. So if you know your numbers, then you know exactly where your business has been and where it is heading based on trends. So the more you know your numbers, the better your business will be.
Okay, so we'll be reviewing each of these key reports. So your trading account, which I'll go into a little bit more detail in a minute. It actually forms part of your profit and loss. We'll look at your balance sheet, and we'll look at a depreciation schedule, fixed asset schedule. What else do we call it? Asset schedule.
Yeah.
So they're all one and the same thing. So let's start with a trading account. So like I just said, it's like the top part of your profit and loss. And it actually affects many businesses, particularly if you sell goods or services, and it will help track your sales, your variable costs, which we actually talked about in our last seminar, and those are costs that increase with your sales, and also gross profit, to calculate the return that you're achieving before deducting all your fixed costs, which Teresa will look at. It indicates whether your margins are improving or deteriorating. You can also use multiple trading accounts to track results for different divisions or product lines. So let's look at regions, for example. So if you use Xero, we call them tracking or categories, and you might be able to see what your business is doing in Logan, Gold Coast, Sydney, Melbourne, whatever it is, and you can actually track how they are going on an individual basis. It's quite powerful reporting, but basically the lesson is small adjustments in your P&L, and particularly in your trading account, can have a huge impact on your overall results. And I'll demonstrate that through our example company called Foodco, because that's so original. Black screen. So here we have the trading account for Foodco. Here it is. So we have sales of just over $1 million. We've got cost of sales, just $318,000. Your gross profit from trading is about $700,000. Total direct costs, these are your variable costs, which should increase with sales. It's $450,000. You've got gross profit of $248,000, and a gross profit percentage, which is your gross profit divided by your sales, 24%. So now let's walk through some improvements that this business could have made. So if you're here at our last seminar, let's say we had a 10% increase in sales because of customer retention. We had a 5% decrease in sale because you've improved your inventory processes. And then let's say you've gone out to your suppliers and you've renegotiated contracts, and we've worked out a 5% saving in your direct costs there. So let's see what that equals. Oh, my head's in the way. Can I move that because I can't see? There you go. So the difference is you've now improved your sales by 101,000 and you've improved your bottom line here. Can you see that? By 389,000. So that's $140,000 just by these 3 small improvements. That's a GP now of 35%.
Thank you, Leishan. Okay, so now that Leishan's taken you through the trading account, which, just to summarise again, forms the top part of your profit and loss statement, I'm going to take you through the rest of the profit and loss statement. In practice, most small businesses will just see a P&L statement that will combine the two. So that's totally fine to have it like that as well. So your profit and loss statement, it tracks the overall performance of your business. It tracks your income and your expenses for a given period. So what I mean by that is a profit and loss statement and also the trading account will track your income and expenses over a period of time. That's different to, for example, the balance sheet, which tracks your position at one point in time. So just to, I guess, demonstrate the difference between the two. The profit and loss statement also provides a really good framework to benchmark results. So, for example, we were talking about budgets before. If you have a budget that you upload into your accounting software, you can compare your actual P&L results to your budget and see at any time how your business is tracking. You can also compare the period for this year with the period last year to see if you have improved on your business and your results over time. The other thing you can do is track yourself against industry benchmarks to see how you are going against other people in your industry. So profit and loss statement on its own already gives a lot of information. The minute you start comparing it to other things, it becomes really powerful in the information it can give you. And lastly, a really common way to value a business is to look at the earnings, and a multiple is applied to those earnings. So your profit and loss statement is a fundamental driver of business value. So let's go through some spreadsheets. More numbers. So you can see here that, yep, here you can see the gross profit. Our starting point is the $248,000, which came from the trading account, which Leishan mentioned earlier. So again, we're looking at our fictitious company, which is Foods Co. You can see here, so we start off with that, and then we run through all the different types of expenses, and these are the operating expenses or generally fixed costs within the business. So they're things that don't really change in relation to sales. It includes things like rent and insurance and telephone, etc., etc. So as you can see, the company, before the adjustments that were made that Leishan went through, was running at a net loss of about, is running at a loss of $113,000. Now, let's say that the company engages a business consultant and as a result of that reviews various expenses and identifies potential savings. So in this example, we identified savings in insurance and in rent. So the business was able to negotiate better insurance premiums and also renegotiate rent with the landlord, which provided some savings, as you can see there. So overall, about $3,500 worth of savings in those expenses. However, you will see and notice that business consulting fees have gone up. And this is just to demonstrate that sometimes in order to improve your business, you may need to engage help from certain consultants. It might be, say from us to help reduce tax, or it might be, social media consultants to help with increasing in sales, whatever it might be. So despite all of this, you can see the bottom line here. That by making those small differences, we have a new net profit. So we've gone from a loss of about $114,000 to a profit of $24,000. That is a difference when you compare the trading account changes that Leishan went through before as well, of $138,000 increase. That's huge.
Enormous.
It is. So I guess what we really wanted,
Changes, yeah.
what we wanted to show with this example, and we really believe in this, the whole 1% improvement every day, it has such a compounding effect. So by making small changes in your business, it can really add to the bottom line. So if we look at your balance sheet, which is also known as a statement of financial position, it provides, like Teresa said, a snapshot at a particular point in time of your business's financial position. So it measures the net worth of your business, which is your assets less your liabilities. It also shows if your business is solvent, and if your liabilities are greater than your assets, then the business may be insolvent and urgent action needs to be taken. But if you don't know your numbers, you won't know, or it might be too late. So you can compare, again, different periods to determine whether the business's net worth is increasing or decreasing between years, and you can track the strength of the business. We look at balance sheets at all sorts of different dates just to compare where the business is. And the stronger your balance sheet, as we have learned through COVID, the easier it will be for your business to survive things like COVID, which are completely out of the normal. It also provides a basis to calculate key ratios, and we're actually going to look at some now. Here we go. More numbers. So as you can see, this company is currently insolvent. Look at its negative assets here. And so its liabilities are more than the total assets. Also, its working capital is negative. So if we have a look here, so we've got total current assets of 138,000 and total current liabilities of 162. So this means that the company can't pay its short-term debts out of cash, debtors, and the stock that it has on hand. So again, urgent action is required to remedy this. So the business needs, like I alluded to earlier, a cash injection of about here, $305,000. So this can be through the form of share capital or a shareholder loan. So assuming that the company can resolve these issues, there are other areas for improvement that every business can undertake. So let's have a look here. So over the long term, the company can implement a strategy to reduce debtor days and inventory days. And we're going to look at these examples now. So to calculate your debtor days, you've got your debtors of 72,000 divided by your sales, which I mentioned in the trading account of just over $1 million, times by the number of days in the financial year is 26. So this is the time that it takes for debtors to pay you. This may be within your trading terms, or in this case, it's actually exceeding the company's trading terms. So let's say that the company is able, they've updated their terms of trade and they've requested payment within, let's just say, 7 days. And you know how things go. So say they've made a 5-day improvement in that turnaround time. So in that case, we've got $1 million, which I mentioned previously, divided by number of days in the year, times by our 5-day improvement. So basically, instead of taking 26 days to collect debtors, now it takes 21 days. That means that's a cash flow positive of nearly $14,000. So that's an extra $14,000 in your bank account 5 days earlier.
Yeah, as opposed to, yeah. So inventory days, let's have a look at the power of changing this. So inventories, 64K, divided by your cost of sales, which again, if you refer back to the trading account, was about 318,000, times by the number of days in the year equals 74. So that's the number of days the company currently holds its inventory from the day it purchases it to the day that it sells it. So let's say they make some improvements in inventory processes and they cut that down by 9 days. So again, we've got your cost of sales, 318,000 divided by 365, which is the number of days in the year, times your number of days of improvement, 9 days. That's a cash improvement of nearly $8,000. So in total, that's 22,000. And whilst that's not going to fix any solvency issues, it definitely shows you how much cash can be saved in a very short period of time when these issues come to a head. I hope that makes sense.
Okay, so I'm going to take you through the last, I guess, financial report that we'd like to bring to your attention. I know you're nearly done with the numbers side of it. So the fixed asset register. So just so that you can put it into context, the fixed asset register, if I take you back to the balance sheet that we showed you earlier, you can see on the balance sheet, we've got a line here called property, plant and equipment of $375,000. So what the fixed asset register or depreciation schedule, you can use those terms interchangeably. What it does, it breaks that line into all the assets in your business. So it also facilitates the spread of cost over the assets over their useful lives. So you've probably heard the term depreciation. So that is basically tracking. You bought an asset for a certain amount of dollars in year one, then over time, that asset will depreciate in value and the fixed asset register will keep track of that for you. So it helps you keep a track of your business assets. It can also be a useful guide on an annual basis to review it and determine what assets might need to be replaced. So you can put that and factor that into your budget. It's also very helpful when you're selling a business. So often if you're ever going to sell a business, the purchaser will want a list of your assets. If that is not maintained, then that can sometimes affect the value of the business when it's sold. The other thing that has really come out that we'd like to bring to your attention is that often a business will have 2 fixed asset registers. So a business,
not dodgy, I promise.
So a business might have an accounting fixed asset register, and it may also have a separate tax fixed asset register. The reason for that is because with the many government incentives that we've seen lately, small businesses can now write off assets in full with no limit. So you could buy $1 million asset for your business and get an outright deduction for it in your P&L. So if you get an outright deduction for it, it's not recorded on your balance sheet. That affects the value of your business. So what you want from an accounting perspective, you actually want to record the assets on your balance sheet and depreciate them over time, even if you get a tax deduction upfront for it. And that is why we definitely do it for all our clients. Yeah. They have 2 separate fixed asset registers for accounting and tax to preserve the value in the balance sheet, but also get the outright deductions for tax purposes.
Just looking at that assets, trying to get your assets to exceed your liability.
Exactly. Which is how it should be, because even if you write off an asset for tax purposes, you actually still hold it in your business. So let me take you through our last spreadsheet, the fixed asset register. Lisa's laughing, but I will persevere with her. So the first columns show the list of assets and also the cost that they were bought for. So in this example, I'm just going to focus on the motor vehicles here. So you can see this business has a van that was bought originally for $22,000 and a car that was bought for $32,000. The next column shows the opening written down value of the asset. So this is the cost at the beginning of the year that has not yet been depreciated for accounting purposes. So in this case, if we look at the van, you can see that the van was already depreciated in prior years, and we've got an opening written down value of about $7,800. The next 2 columns will show purchases and disposals during the year. So in this example, you can see that the car was purchased during the year for $32,000. Moving on, the next 2 columns will generally show you the rate and methodology of how these assets are depreciated. So if we take the van, for example, you can see the van is being depreciated at a rate of 30% per year using the diminishing value method. So all that method really means is that we're depreciating greater amounts in the earlier years, and that depreciation tapers off in the later years.
the other one's straight line, but that's really an accounting.
Yeah, we generally don't use straight line very often because diminishing value just gives you better results. So continuing on, the next column in our depreciation schedule or fixed asset register is the actual depreciation charge. So you can see for the van, that depreciation is calculated by looking at your opening value, so what you've got left to depreciate, times your rate, gives you your depreciation charge. So you do this for all your assets, and that total charge there is what then ends up as a deduction or an expense in your profit and loss statement. The next column is the accumulated depreciation. So this is all the depreciation charges that have been claimed in prior years. The final column is the closing value. So you can see if we continue on with the van was started off with an opening value of $7,800. We added an additional $2,300 for depreciation, which gives you your closing value of $5,400. So this closing value, the total down here, is the amount that you will then see in your balance sheet. So this is how the fixed asset register ties into your balance sheet. Now, I do want to note, you're probably going, you might remember in your balance sheet that we showed earlier, the total property, plant and equipment line was about $375,000. This is just an extract. We didn't want to expand it right out and confuse you with lots of numbers on the page. But basically, to tie it all in, the depreciation column, that hits your P&L as an expense, and the closing value is the value recorded in your balance sheet as an asset. So hopefully that all makes sense to you.
This is my favourite part because it's the difference between profit and cash. And this is a great saying. So turnover is vanity, profit is sanity, cash flow is total reality. So it's very common for business owners to get frustrated that their bank account just doesn't reflect their profits. And I think we get that question.
We do
quite
all
a
the
lot.
time. Yeah.
So it's essential for you to understand the difference between profit and cash, and why a high profit doesn't necessarily result in heap cash in your bank account. So a profitable business can go out of business because it's cash starved. A business running at a loss can survive because it's got access to investors or financiers or something. So in other words, cash flow is every business's reality. So we're actually going to go through a few examples on the next slide. So here we have GST. And so this is really just to demonstrate the difference between profit and cash. So GST, I wish I could have you all on speaker, but I don't know how to do that, sorry. So anyway, GST is cash because almost always your P&L will be GST exclusive. Loan repayments, cash. Come out of your bank account and reduce your loan accounts, which are on your balance sheet. Interest, interestingly enough, oh, that's funny. Accounting joke, ignore it. I can't even believe I said that. That actually affects both. So in cash, because it's a component of your loan repayment, and P&L, because we record interest on your profit and loss, which most of you will have seen. Asset purchases, what do you reckon? Cash. And like Teresa just went through just now, so with that car.
It was a car. That was
32 grand.
32,000.
So cash out of your bank, but then straight onto your balance sheet. Doesn't touch your profit and loss. Asset sales. Now this is an interesting one because it does affect cash. But if you know how we looked at your written down value, if you've got a profit, or if you sell your assets for greater than your written down value or less than your written down value, so you've got a profit and loss on disposal, that will affect your profit and loss. What about depreciation? Totally a profit adjustment, because this is just measuring the effective life of an asset, nothing to do with cash.
Ooh, great.
There you go.
Okie dokie. So I'm going to take you through a really cool model or business cycle. Cool. It is quite cool. So what this does, we've just been through the different types of reports that you might see in your business. What this does, this actually shows the relationship between your profit and loss, your assets, and your cash position, so you can see what happens in a business. So, firstly, the owners of the business might invest some money into the business. That money can then be used to buy assets, which generates income in the business. The business may need to borrow some money from the bank to acquire more assets, which continues to grow the assets. The assets are then used to generate profits in the business. So, ways that you can increase the profit is through sales growth and margin growth, for example. Ways that you decrease profit or profit drains is overhead type expenses. So this is where it becomes really important to be able to monitor your overheads. And I keep going back to this budget, but if you set a budget at the beginning of the year and you monitor it against how you're actually going, that will help you identify areas where you might be overspending, and that's something that you can then work on improving. So the profit then gets turned into cash. If we have a look at cash, some drains on cash flow include slow collection of debtors. So you might exactly. So you might recall Leishan's slide where she went through debtor days and how just a 5-day reduction in debtor days can really improve your cash flow. It's really so powerful. Other drains include business loan repayments or even tax payments. Which we see. So, but we can help with that. So, gains. So, how can you improve your cash gains in your business? Faster collection. Again, reduce those debtor days. Decreases in stock or work in progress or inventory days, which is the other ratio Leishan went through. You can also look at ways to reduce tax payable. And in fact, our next webinar is going to be all about tax planning strategies before 30 June.
Now that you put it out
there. Yes, that was the aim. That was the aim. So what does this all mean? So then what happens with any leftover cash? The owners can draw that out, and that is basically a return on the business. So the aim of this model is to go through this cycle as quickly as possible, reduce your drains and increase your gains, because so what that means is that the more cash you can generate that you can turn into income producing assets, the more profit you'll get, and you'll get a good cycle for your business. Yes.
Cool. Okay, so after cash flow, business value is the next most important measure of business success. So part of knowing your numbers is understanding and measuring the drivers of your business value. So these drivers might be monthly recurring revenue, revenue growth, revenue per client, sales, or profit. They'll be different for every business, but we can work with you to identify the drivers of your particular business's value. And so Therese is going to walk you through now how to maximise some of that business value.
Okay, enhancing business value. So this is so crucial, and it's often a step that is missed completely in small businesses, is implement a clear business plan. If you have a clear business plan for your business, you will be so much more equipped to deal with any opportunities or challenges that might come your way.
Where the energy goes, the focus flows.
Where the focus goes, energy flows.
That one.
Exactly. So have a business plan. Don't just chuck it into a drawer, but take it out and make sure you monitor it on a regular basis so that you can track how you're going with your business.
We look at ours at 4 monthly sprints. Yep. So that's over a 4-month period.
Yep. And lots of times in between as well, definitely. So the next thing is document your organisation structure and roles. So really document who is in your business, who is contributing to your business, and what their roles and responsibilities are. The next one, which is really the crux of this whole entire webinar, is establish a good cloud-based real-time reporting accounting system. So Xero is, we work with all different accounting systems, but Xero for us is by far our favourite. It's got amazing reporting capability, but we also see the add-ons are really good. It is. We also see MyOb, QuickBooks, and there's various other ones out there. So by having real-time reporting, you can really monitor and understand your numbers on a real-time basis. That's very different to the old days where, you put all your receipts into a shoebox, you hand it to the accountant, we do the finance, no shoeboxes, please. Well, you hand it to the accountant, we provide you with financial statements. That was from last year. So there's no point in looking at numbers from a year ago. It's not going to help you with where you are at right now, especially in this fast-paced environment that we're all finding ourselves in. The next step, and again, this is so important in your business, is review and document systems and processes. So this is an admin task, and we often go, when we need to do it, but it adds so much value to your business. It is. So all your owner knowledge in here, put it down on paper, which takes me to my next point, reducing reliance on owners. The more you can get other people to do what you can do, and that's documenting systems and processes is a really good way of doing that, the more value you add into your business. The last way of enhancing business value, and it's not really the last way, there's a lot of different ways to do it, but managing risks, identifying and managing risks. This is often done as part of your business planning at the beginning, and that way you can identify risks and mitigate them and manage them before they become a real issue.
Okay, so as we've seen throughout the webinar, the profitability, cash flow and value of your business affects you personally. If your business isn't profitable and doesn't have much cash, then you're not going to be able to pay yourself to live the lifestyle that you want or deserve. So your business should work for you and not the other way around. And I reckon 9 out of 10 businesses are probably the other way around. So there are a few things we can do to help you protect your assets, and I'll run through a few right now. So limitation of liability. So if you're a sole trader, for example, you might look at structuring, so whether it's into a company or a trust or something, they're all factors that you can look at to limit personal liability. You can consider who should be a director of the company and which assets are being held personally. So, for example, if we have a husband and wife, wife is a lawyer and husband works for a bank. So wife is the risky person. So in that case, we would normally have her as a director for most of the business entities. Or in terms of holding assets, we'd have the husband as he's what we call the safe person. I don't know if banking safe, but for the purposes of my example, let's go with it. The next thing is security for loans provided. So ensuring you have security if you lend mother to others, money to others.
I'm not lending my mother.
Yeah,
she's a keeper.
So in this instance, we'd always refer you to a lawyer to get legal contracts, depending on the amounts, legal contracts drafted. If you've, I don't know, for some reason bought someone a car, you'd register that car on the PPSR, which is really, really important, because if you don't and they go bankrupt, car's gone, too bad, and you're left with the liability. So sad. Ownership options for high value assets. So this is where, say, in a business, in a trading business, you might operate a commercial premises. So we would look at it and go, for asset protection, that's not what we like. We would like to take the commercial premises out and put it into another entity so that's away from the risk of your trading enterprise. Now, don't do that without coming and seeing us, because there are stamp duty issues with that, and there may or may not be CGT liability tax issues. So we would ultimately, if you were going to buy a commercial premises, we would talk to you about structuring options, which goes to point 1. If it's inside a business already, you'd have to do a cost benefit analysis to get that property out of that business. You might want to look at your terms of trade and credit policy. So we're noticing that a lot more people are getting payments upfront. They're asking for credit card details or debit details so they can take money out of your card or your account straight away. So that's another way to protect your business. Insurance. This is so important. So you've got to make sure you have sufficient protection. So, for example, do you have business interruption insurance, indemnity insurance, all costs a fortune, I might add, but enough cover to ensure that the impact on your business in the case of any adverse event is as minimal as possible. Financial planning. So this goes back to my point about getting the business to work for you. So you'll sell that business eventually, and it's all about managing your personal wealth. So making sure you are taken care of and can live the lifestyle you want in retirement. The last thing is estate planning. So we never know when we're going to die, but you've got to plan for the future. So do you have an up-to-date will, powers of attorney, and a clear plan for transferring your assets to the next generation if that's important to you? We have seen so many cases where it ends up being a total basket case and the only winners are the lawyers, which is really, really sad. So this isn't an exhaustive list by any stretch of the imagination. They're just some of the ways that you can protect both your business assets and your personal assets, and we can help you identify specific ways that you might need to do to protect your assets. Yes.
Great, thank you, Leishan. Okay, so the next part of the agenda is adopting best practice. So we've identified 3 essential tools that every business should have. So we've talked about these throughout the webinar. The first one is every business should have an annual business plan. This is so, so important. The next one is every business should also have an annual budget, and that should be uploaded into your accounting software so you can track it and monitor it as you go. Additionally, you might also like to have a forecast. So cash flow forecasts are really, really good because what they do is they identify where you might have a deficit in the future and you can do things now to mitigate that. Lastly, the third essential tool is ongoing reporting and accountability. So there's no point doing a business plan and a budget and chucking it in your drawer and forgetting about it. It's really important that you monitor it on an ongoing basis so that you can see how your business is going and make all those little micro adjustments that we discussed and talked about in our example. Before this webinar, we were actually having a look at the most recent stats on small business. Yeah. And you've probably heard these numbers before, but I will repeat it because it's scary. So more than 60% of small businesses in Australia fail in the first year. That's so scary. It's scary. What's even scarier is the top 2 key reasons that small business fail is lack of planning and lack of cash flow management. So you've got tools that you can use to manage both of those, but they're the 2 key reasons that businesses in Australia fail. So knowing your numbers really is just the beginning. It's really, really important to know your numbers so that you're equipped with the right information to take your business forward. So your next steps and where to from here in such challenging times, I guess. So our aim today is to help you take what you've learned today and implement some positive change in your business. So what we'd like you to do is decide what you're going to do. Write down, after the webinar, of course, write down 3 actions or projects that will actually add value to your business. Then look at what problems are you experiencing in your business. And by identifying these problems, you can use them as an opportunity to create a project to fix them. And I think what we've seen is that some of the greatest opportunities come out of challenging issues. It definitely changes, doesn't make you go crazy. What I'm trying to say, changes your thinking. But doing nothing right now is not an option. Okay, so how can we help you with all of this? If you don't currently have a business plan, make sure you get one. We can help you develop them. We've got some amazing templates that we can step you through and help you create a business plan. It is a process. You need to have a good business plan that captures, a wide variety of issues. So we can help you with that if you like. The other thing, especially coming up to end of financial year, so that you're all set to go for next financial year, is start thinking about and creating an annual budget. So remember, that is where you would like your business to be in 12 months' time. A third way we can help is with cash flow forecasting. So this really helps you with managing your cash flow. The fourth way is coaching. So we offer to a number of our clients coaching sessions where we help you set up your KPI or key performance indicator dashboard, and we help you monitor that either from month to month or quarter to quarter, depending on what your business needs are. And lastly, if you just want to give us a call to have a chat about some of these options or what you might need in your business, please feel free to give us a call and we can set up a call or a Zoom meeting with you. Lastly, and I need to say it because it's part of the webinar, so this is our little disclaimer, and I wish I could say it. I haven't practiced to say it. You know how on the ads they say it very quickly. So the information in this educational webinar is general in nature and no substitute for specific tailored advice and support. So by working with you one-on-one, we can really help you identify the key aspects that relate to your specific business and what can make the biggest impact on your results.
Question time. We have a question. Woohoo. What was your main balance sheet focus before COVID, and what is your balance sheet focus now after COVID? Interesting.
Great question. It's a really, really good question.
So I think, like we said, the balance sheet shows the strength of your business. And as you can imagine, people's balance sheets pre-COVID were growing. There was no doubt about it. The economy was going really well. Then COVID hit and it smashed and decimated so many balance sheets. And even for businesses that had strong balance sheets, they're worn down. And so now after COVID, we're looking at that where assets exceed liabilities.
I think cash is a main focus after COVID. So really maintaining cash inflows greater than cash outflows. So cash is a major, major focus for many businesses right now after COVID, and ways to increase the cash balance,
so we want basically 3 months worth of operating costs in cash flow, in your bank. That's what not all businesses have it at the moment, but it's something that you want to grow to. And then balance sheet analysis to see
ratios
if there's any, particularly that where your working capital ratio. So if your current liabilities are exceeded by your current assets are exceeded by your current liabilities, that can be a problem. So I hope that's answered your question. So we have another question, and that's what is the difference between the annual accounts and accounts that can be produced throughout the year? It's not a good question. So your annual accounts are where we've done our accounting crap. Did I say crap? No.
Accounting stuff.
So it's got your depreciation and it's got your tax. We've split interest on loans. It's got prepayments and stuff in it. Whereas your management accounts are live data. That's where your business is right now. So you don't really care about your annual accounts because, like Teresa said, they're like 12 months old by the time we get to it sometimes. Whereas your management accounts give you up-to-date data.
Good question.
Cool.
Thank you.
How are we going for time?
We think we have. We've probably got time for one more question. Yep. We've got time for one more question. So this question: what is the difference between a budget and a forecast?
Ooh, okay, I like that one.
I'll take this one. Okay. So The budget is basically a statement of your expected revenues and expenses for a period. And the budget is normally set before that period starts. So right now, you could set a budget for next financial year, for example. Once that's set, the budget does not change. It's a reflection of where you would like your business to be in 12 months' time. Versus a forecast. A forecast is a projection of what might actually happen, and a forecast can change as the year progresses. So the forecast shows you where your business is likely to go, knowing what you know now. So Alicia was talking about management accounts. This is where management accounts and real-time reporting come into play. So they can help you track, where you're likely to go, and things that you didn't know at the beginning of the year when you set your budget. And both are very, very important to be able to understand so that you can monitor your business going forward. I think that's it for the questions.
That's it, yeah. It's just...
Okay.
Oops. Thank you.
Thank you.
Thanks for making the time to attend today's webinar. We appreciate that your time is super valuable. When you exit, there'll be an exit survey, and we'd love for you to complete it. 1, so that we can continuously improve, obviously, but 2, so that you can give us some ideas for other webinar topics that you might be interested in hearing from us on. So hopefully we've given you plenty of ideas to ponder and some clear next steps to take for you and your business. So that's it from us.
Thank you so much, and stay tuned for our next webinar, which will be all about tax planning just in time before the end of the financial year. Thank you, everybody.
Awesome. Okay, bye.